Hey guys, I hope you had a great new year and welcome back to the channel. In today's video, I'll be sharing with you the 5 lessons I learned from Paul Tudor Jones trading principles. Paul Tudor Jones is a billionaire hedge fund manager of Tudor Investment Corp. Paul Tudor Jones is inducted into the Institutional Investors Alpha's Hedge Fund Manager Hall of Fame alongside other giants in the stock market such as David Swensen, George Soros and Stephen Cohen. Perhaps one of the more well-known examples where we got to see the results of Paul Tudor Jones' trading strategy is during the 1987 Black Monday crash. During that stock market crash, Paul Tudor Jones managed to make $100 million, and he is also one of the market wizards featured in Jack Schwager's best-selling book, Market Wizards. So in today's video, we'll be taking a look at some of the trading principles that Paul Tudor Jones uses to guide his trading in the stock market. The first lesson that I learned from Paul Tudor Jones is to focus on great defense rather than on great offense. What does that mean? Many people, me included at the start, believed that generating returns in the stock market was the most important thing, and we only focus on making money. However, over time, with lessons learned and experience gained, I also came to realize that risk control is the most important thing in trading. We shouldn't make making money our focus. Rather, we should focus on protecting what capital we have. And the reason is illustrated in the next example, which I will be going through with you now. This chart shows an initial capital of $1,000 and what happens to our capital based on these different percentage losses. And this table also shows the percentage gains that we have to make in order to break even after we have suffered those percentage losses. So an initial capital of $1,000 when suffered a 90% percentage loss results in a new value of $100. And for this $100 to be back at the initial capital of $1,000, we need to generate 900% gains. And for an 80% loss to our capital, we need to generate 400% returns in order to break even. And for 70%, we need 233%. For 60%, we need 150% returns. For 50% loss, we need 100% gain. For 40% loss, we need 67% gain. 30% loss for 43% gain. 20% loss for 25% gain. And finally, 10% loss for 11% gain. So as you can see, as our percentage loss goes down, the amount of returns we need to generate in the stock market to break even becomes exponentially lesser. Right, so for a 10% loss, we just need to generate 11% returns in order to break even. But as we go higher, for example, a 50% loss to our initial capital, we need to generate 100% returns in order to break even. And to generate 100% returns in the stock market is no mean feat. That is not to say that it's impossible to generate 100% returns in the stock market. In fact, some of the best traders in the world, such as Mark Minervini, has managed to generate triple-digit returns in the stock market before. However, not all of us are like Mark Minervini. We want to focus on risk control so as to limit our potential downside. It is way easier for us to claw back to break-even point by suffering a 10% loss to our capital rather than a 50% loss to our capital. In fact, even some of the best traders in the world such as Paul Tudor Jones and Mark Minervini make risk control a priority so as to limit their potential downside. And that is the first lesson I learned from Paul Tudor Jones, that we should focus on great defense rather than on great offense. The second lesson that I learned from Paul Tudor Jones is his trading style, specifically when it comes to winning and losing. When Paul Tudor Jones is trading badly, he will cut down his trading volume. And when he's trading well, he will increase his trading volume. And this is opposite to what some traders might do in the stock market. These traders are more likely to increase their trading when they are trading badly compared to when they are trading well. After they have been trading poorly for quite a while, their losses start to pile up. And these traders might feel the need to recoup their losses immediately or as soon as possible. And what they will do is increase their trading size, so that if they are right on that trade, they will be able to recover the losses from the previous trades. It's a bit like the all or nothing mentality. But if we are serious about trading in the stock market, then Paul Tudor Jones advises us to decrease our trading volume when we are trading poorly and increase our trading volume when we are trading well. When Paul Tudor Jones is trading badly, he will keep cutting down his position size. For example, if his normal position size in the stock market is 10% of his total capital, when he is encountering losing trades, he might cut his position size down to 8%. And if he still encounters losing trades, he will further cut down his position size to maybe 6%. As such, he will be trading his smallest position size when his trading is at its worst. And when he starts to turn a corner in the stock market, and the trades he takes starts going in his direction, he will slowly increase his position size again. So he will decrease his position size when he's encountering losing trades, and he will increase his position size when he's encountering winning trades. And that is the second lesson that I learned from Paul Tudor Jones. The third lesson is time stop. As traders in the stock market, most of us are familiar with price stop. Price stops are stop losses that we set in the stock market. If you want to find out more about stop losses, I have a video over here talking about stop losses and how to set them in the stock market. On top of stop losses, Paul Tudor Jones also incorporates time stop. For a time stop, Paul Tudor Jones will set aside a period of time for the stock to move in his direction. For example, if he gives the stock 2 weeks to move, and he thinks that the stock should take off during that time period but it doesn't, then he will often get out even if he's not losing money. Let's take a look at an example of why time stop can be important for us in the stock market. For this example, say we entered our position at around this candlestick over here, which is during early April. And we set our stop loss or our price stop just below this bullish candlestick over here. So maybe around at this point over here. And from April all the way to December, you can see that our price stop or our stop loss wasn't hit during this period. However, just because our price stop or our stop loss wasn't hit, it doesn't mean that we made a good trade. Because as you can see from April all the way to December, prices were basically moving in a very tight consolidation. And after about 8 months, we haven't made any tangible returns in the stock market. And this would have been a bad trade if we have took it. Because even if our stop loss wasn't hit, and we never really lose money in the stock market during this period, we basically had our money tied up for the better part of the year. And that is an opportunity cost for us as traders in the stock market. Because if our capital is tied to a certain stock, this means that we are foregoing another opportunity to enter another stock. And if our capital was tied to this stock, we would have probably missed out on other opportunities to generate returns in the stock market. And that is why for the third lesson that I learned from Paul Tudor Jones, we want to have our time stop on top of our price stop or stop losses. That way, price stops and stop losses will help us to control our risk, and our time stop will keep our opportunity cost low. For the fourth lesson, we don't want to average losers. Say we enter our long position or buy position in a particular stock in the stock market. Based on our analysis, we decided to trade the stock because we believe that the stock is likely to move up. However, in the event that the stock moves down and against our direction, we want to avoid buying more and increasing our trading position in that particular stock. Because if we believe that the stock is likely to move up, and if the stock moves against us, it either means that we entered too early or we were wrong in our analysis. Note that this applies to trading and not to investing. For trading, we don't want to average down, but when we are investing under the right conditions, averaging down can be a good strategy. But in this video, we are talking about trading. And for trading, we never ever want to average down. The fifth lesson that I learned from Paul Tudor Jones is to trade with the trends. He believes that the best money or the big money is made at market turns and market trends. Markets tend to move sharply when they move. Prices can move up very fast, or prices can move down very fast. If we trade with the direction of the price movements, we can generate substantial returns in the stock market, especially if we are able to catch the start of a trend and the end of the trend. With that said, trying to pick tops and bottoms is likely to result in us incurring multiple losses. So if we manage to catch the top and the bottom here, we would have made substantial returns shorting the stock. And if we manage to pick the bottom here and pick the top here, we are also able to generate substantial returns. It is near impossible to catch the tops and bottoms consistently in the stock market. If we are able to just capture the middle portion of the trend, we would also have been able to make decent returns. And that is why for the fifth lesson, we want to trade with the trends. Because by trading with the trends, we do not need to pick the exact bottoms and exact tops for us to capture a significant portion of that trend. That is the 5 lessons that I learned from Paul Tudor Jones trading principles. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this in the future. And if you haven't already subscribed to this channel, make sure you subscribe to this channel because each week I release new videos about investing, trading and the stock market. I'll see you in those other videos. To your financial success.